In this week's video, we'll review the latest charts and data to help us answer the question, stock market bubble, is it time to get out? The commentary that follows is based on the data that we have in hand at the time of the recording. It's also based on our long-term investing approach. Yours may vary. Before we get into the present-day market and the back end of the video, we're going to talk about where we are in the AI cycle and the concept of AI being in a bubble. Clients and regular viewers know the stock market was in a secular bull market from 1982 until March of the year 2000. And of course, during that period, you heard the word bubble a lot. Business Week's story dated September 16th, 1985. A nation increasingly behaving as though the stock market were a casino rather than a capital market. Now let's assume you read this story and you decided to liquidate all of your stock holdings because the stock market was in a bubble. Thus, we might want to ask and answer, how long did it take before the bubble popped? And how did the S&P 500 perform walking forward from the date of publication? September 16th, 1985. The answer? Quite well. After Business Week said the stock market was a casino rather than a capital market, the S&P 500 gained an additional 735%. Now, if you know your stock market history, you know we did have a stock market crash in 1987, and that is significant and extremely relevant. However, on the back end of that crash, October 26, 1987, the New York Times said the pre-crash run was a classic speculative bubble. So let's say that you adopted the bubble psychology in October of 1987 and you decided that you had enough with the stock market. Or let's assume you were so scared after the crash that it took you several years to get back in. How painful was that? Extremely painful. The S&P 500, from the date of publication, October 26, 1987, gained an additional 571%. In fact, the S&P, for the most part, had made its major low. We had a retest here in October of 1987, and on a closing basis, we undercut the low. But liquidating in this area here was not a good decision. What's the moral of the story today? If the market has a waterfall decline sometime in the coming years, it doesn't necessarily mean the secular bull market is over. But that's another topic for another day. Keep in mind, we started with a cover story in 1985. Then we went to 1987. Now let's fast forward to a journal publication in the winter of 1990. Title of the paper, On Testing for Speculative Bubbles. Now keep in mind, at a minimum, the bubble talk has been going on for 5 years. Very easy to get spooked out of the market when you hear bubble, 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 day after day for 5 years. But the real question in 1990 was, should you have stayed in the market, and how much upside was left in terms of magnitude and duration? So walking forward from January 15th, 1990, a date we arbitrarily picked as the winter of 1990, the S&P 500 tacked on an additional 353% and went up for roughly a decade. And this is after we've been talking about bubbles for at least 5 years. If we fast forward to April 5th, 1994, story in the LA Times quoted President Bill Clinton as saying the Fed partly raised interest rates because they were aimed at bursting the stock market's bubble. There's that bubble word again. We heard it all the way back in 1985, and here we are in 1994, and the bull market is alive and well. But 9 years of bubble talk, that's stressful. So if you said you've had enough in April of 1994, that was unfortunate from a longer-term perspective because the S&P 500 tacked on an additional 241% before peaking. Now we've been talking about bubbles for over a decade. Can you imagine if you got out in 1985, the first whiff of a bubble? And now we're getting to a well-known Alan Greenspan speech. Alan Greenspan was the Federal Reserve chairman at the time, and he said market participants were experiencing irrational exuberance. He warned of unduly escalated asset values. And one takeaway is the word bubble from an investing perspective has not been particularly helpful as a timing tool going all the way back at least to 1985, and now we're in December of 1996. But if you cried uncle in December of 1996, that too was painful. The S&P 500 basically doubled before it was over. It moved from 725-ish to 1,400-ish, a gain of 105% using closing prices. We started in 1985, now we're in 1997. Opinion piece from the Washington Post basically warning the U.S. that if some of these bubbles start to pop, it's going to impact a lot of things, including numerous political topics. Was it over on October 12th, 1997? The answer is no. We still had 58% upside from that date. And relative to the numbers that we've covered so far, that doesn't sound like a lot. That's a lot. A 58% gain on $1 million is not chicken feed. Talk of speculative excess in 1985 was not particularly helpful. And when the Bureau of International Settlements included in their annual report flags that we had equity price bubbles in the US and Asia, at that point, you may have stopped paying attention. And that's how bull markets work. Secular trends can last so long that we have to keep in mind that in this business, being early is being wrong. The S&P still had some juice in it from mid-June 1998. And again, a 42% gain on $1 million or $5 million, that's significant. And there's nothing particularly scientific about what we're covering here. The point is the ongoing talk, and the talk that most likely will be ongoing in the coming years about bubbles. At some point, it will be relevant. And when it's relevant, it will be reflected in the weight of the evidence. And given we started in 1985 and bubble warnings in 1998 still weren't particularly helpful, it makes it easy for us to focus on the charts in front of us rather than the bubble talk. The point of the exercise speaks to human emotion, human fear, and investor psychology. By no means was this an exhaustive study that we performed. We found 21 cases between September 16th, 1985 and June 15th, 1998, where in a public forum, either in Business Week, the New York Times, the Wall Street Journal, Fed testimony, Fed minutes, annual reports, where the public was warned about excessive speculation. The gain from the first reference in the S&P 500, the market didn't peak for 5,303 calendar days from the first instance that we covered in September of 1985. The gain was 735%. If we look at all 21 instances, the average gain from the date of publication was 282%, and the market rallied on average an additional 7.2 years. Trade the chart in front of you. Our job in the coming years will be to focus on the data, the charts and data sets in front of us. And if we run the same numbers from the same dates for the NASDAQ, you can pause your video player. The average gain in the 21 instances, almost 750%. The median gain, 389%. Now let's shift gears to AI and timelines. There seems to be a misconception that AI is about improving productivity a little bit, and building data centers. And once the build out of the data centers stops, the music will stop. That's like saying you believe that you will never get a new cell phone, or your laptop or your personal computer will never become obsolete. There's an incredible amount of work that's going to be done in the next 10 to 15 years on this topic. In fact, we're already moving to the next ideas in terms of how data centers work today. The general topic is covered in this Wall Street Journal piece. The information on your screen helps you understand in general terms what we're doing today and what the limitations are. But we're already developing ways to improve. We want to reduce the size of those massive data centers, and we want to make them more efficient. And this is an example of AI-driven innovation. You look at the way that we're doing something today in the context of potential future needs, and somebody says, there's probably a better way to do this. And guess what that does? It creates jobs. In fact, you can make an argument that the AI race around the globe has some similar characteristics to the aerospace race between the 1950s and 1970s. And notice how long this goes on. ChatGPT came out just a few short months ago. So it's not just about building data centers. The demand for AI services is going to create tons of innovation in energy and power systems, industrial and manufacturing equipment, transportation and vehicles, computer hardware. It'll drive innovation in materials science, healthcare and biotech, and radically change the way we educate ourselves. The things that we're using AI for today, it's just the low-hanging fruit. Think of it as the software productivity phase. AI improves things that we already do. You're probably using it in your job. But in 4 to 7 years, the robots, the factories, it's not just going to be about software. AI is going to start moving into the real world. Some examples are shown on your screen. And in 8 to 10 years, there'll be further integration. You'll be able to integrate the automated factory with autonomous logistics, so we can make it and deliver it. If we're going to remain objective, we have to take an analysis like this and balance it with what happens in the real world. Even if we remain in a secular bull market, markets have a tendency to get ahead of themselves, just as the present day market has, and then they have a tendency to correct. As we've covered, from October of 1958 to the peak in November of 1968, the S&P 500 gained an additional 115%. That sounds great. And from March of 1991, which is similar to 2025, the S&P 500 gained an additional 310%. But it wasn't a cakewalk. In those periods, the average drawdown greater than 6% was almost 12%. The median drawdown was 9.62%, which means if you successfully navigated from point A to a point B that could be several years down the road, you had to withstand 100% normal and to be expected volatility. And we don't want to assume that something like 1973-74 or the dot-com bust or the financial crisis is a low or zero probability event. And it's also extremely important to keep in mind that massive drawdowns are not unusual in the stock market. Nobody wants to see their $1 million sliced in half. So we don't want to let this become the enemy of capturing this on the right side of the screen, if it still looks like a secular trend. But if we start to morph into something more like this, or this, we can't forget about this. So where do we stand today? If you didn't watch the stock market today and you just looked at the closing price, at one point the S&P was down 88 points. We ran our models when it was down 83 points. The trend strength model, which is part of the CCM market model, the master model, you can see we We're still posting dual 100 trend scores. These are factual. They're based on hundreds of inputs. Has nothing to do with the term bubble or emotions. Same thing can be said for the secular volatility model, which takes a much broader view of markets relative to the market model. They work together. Here are the scores today, and here, these are the type of scores that we would be really concerned about. 24%, 15%, 20%, 10%. And between scores like this and the present day scores, as we see further deterioration, concerns would increase. We just don't have it. And the S&P 500 rallied from being down 88 points on Friday. It takes discipline to stand your ground and look at the data and think long term and think about your long-term objectives when everything on your screen is red. There's a long-term look at the S&P 500. There's nothing on the screen as of 2:31 p.m. or the close that says anything other than secular bull market. And think about everything that we just covered with the AI cycle, where we are today, how long ago ChatGPT was released, and the fact that the demographics tell us that we could be in a secular bull market that could last until 2034 or 2035. Seems to align with these concepts: the 1 to 3 year outlook, the 4 to 7 year outlook, and the 8 to 12 year outlook. We always say we have to understand how markets operate in the real world. If it's happened before, it can happen again. What can we learn from asking and answering this question? What was the maximum intra-year drawdown in these sequential calendar years? 1991, 92, 93, 94, 95, 96, 97. A 7-year period. Said another way, what was the worst annual drawdown in this period? What was the maximum amount of pain that you had to endure to stay in the market for 7 years? Answer? On a closing basis, the largest drawdown in this 7-year window was 10.8%. The median annual drawdown, a tepid 7.04%. We can't assume that 20 to 30% drawdowns happen every other year. In the context of a secular bull market, it's possible to go 7 years and never have an 11% drawdown in the S&P 500. It helps us keep an open mind about a wide range of outcomes. It also helps us focus on the data sets and charts in front of us and keep our fear at bay. Let's ask and answer another question about what's actually happened in the real world. How much did the S&P 500 index gain between the closing low in January of 1991 and the closing high in the year 2000? The answer? 391%. What does that tell us? It tells us, in this period, if you remained disciplined and didn't overtrade your account and overreact during 100% normal and to be expected pullbacks and corrections and scary moments and days filled with red screens from point A to point B that can occur within the context of a long-term secular bull market, you could have done very little for all of calendar year 1991, 92, 93, 94, 95, 96, and 97. And even if you captured near market returns, your gains would have been life-changing. Now ask and answer this question. How would you have felt at the end of 1997 if you were not disciplined enough to stay with what was a clear long-term uptrend between the lows in 1990 and the peak in 1998? It wouldn't have felt good. And here are the intra-year drawdowns here. 1991, 6%, then 6%, then 5%, then 9%, then 3%, then 8%, then 11%. And in that window, the trend was consistently strong with relatively muted drawdowns. Not a prediction in any shape, form, or fashion, but we all have recency bias. We've had a lot of big drawdowns in the past 10 years. Now, this implies strong long-term trend. So in the real world, we'd prefer to have a strong long-term trend. If that doesn't happen, this is what it looks like. An anecdotal example of a strong long-term trend rolling over. It's a chart of the S&P 500 dated December 29th of the year 2000. This is January of 2000 here. We've covered this chart before. It's the 50-week moving average in blue, all the way out to the 110-week moving average in red. Notice the transition here. The 50-week moving average starts to roll over late in the year 2000. Price undercuts all of the moving averages and fails on the first attempt to recapture them. This, over here, looks significantly different relative to this. And here's the second topping process in the long-term period of stagnation, a period of secular stagnation. Same exact moving averages. Blue, the fastest moving average, is on top over here in 2007. The major peak occurs here in October. The transition, you can see, profile looks significantly different over here. This is an alarming look. Tight cluster of failure at the moving averages. You go from full bore bullish to full bore bearish. And the market doesn't bottom for over a year from this window here. So we just said in this period you had a very, very strong long-term trend. Muted drawdowns, excellent gains over a 7-year period. Thus, in the context of the charts that we just covered, does the present day look more like those concerning rollover periods, or does it look like a strong trend? It looks like an extremely strong trend. And this, on November 7th, 2025, intraday, 2:39 p.m. Eastern Time, this aligns better with this relative to this or this. If the present day chart starts to morph into something more like this, concerns would increase. Given what we've covered thus far, our model scores, the long-term charts, if we ask and answer this question, do we have any data in hand that says the secular trend is on the ropes? And relative to the drawdowns in this strong trend window, has the S&P 500 dropped in the present day during the current pullback over 7.04% or over 10.8%? The answers to both questions are no. And hence, it looks like we still have a very strong uptrend based on the data that we have in hand today. And a 391% gain, hypothetically, is significant. And why do we show this? Because you need motivation to offset your natural inclination as a human being to be fearful and being afraid of incurring losses. We need to understand both sides of the coin. Wildly bullish and wildly bearish. It's really the only way that we can maintain our objectivity. You can pause your video player. Takeaway here: when the NASDAQ has a really good run and has a tendency to have 100% normal and to be expected givebacks maybe over the next 3 months, realistic expectations, but that strong trend typically continues. 1 year later, every single case higher, average gain 26.84%. Givebacks are 100% normal and to be expected, even within the context of the strongest long-term uptrends. You can pause your video player here from Nautilus Research. Here's their Twitter handle. It's a study based on XLP, the consumer staples, something that just happened, pretty rare. Here are the signal dates. S&P 500 performance 1 year out, very impressive. NASDAQ performance from the date of these signals over here, extremely impressive. Median gain 35%. If the market goes on to finish with a double-digit return, it will do something very rare. The next year, in the historical cases, the average gain in the S&P 500, additional gain, 19%. The median gain, 17%. Helps us keep an open mind. Got some bad data on the economy. Sometimes bad news is good news for cyclical stocks because it moves the Fed closer to lowering interest rates. During the session on Friday, market pricing currently says there's a 70% probability the Fed's going to cut again on December 10th. It's typically a good thing for tech and cyclicals. Source of this data, very experienced market participants. Chart on your screen was included in a November 4th tweet. It's a 39-minute chart of the S&P 500. It shows possible areas of very short-term support. Here's the same chart updated as of the close on Friday, November 7th. This, right in here, this gap down, this is Friday morning. So this is the close on Thursday, this bar right here. So as of the close on Thursday, we draw this trend line as a reference point. And what you're hoping, if you're a stock market bull in the short run, is either that this level of possible support holds, or during Friday's session, we come down and test this trend line. And that's exactly what happened. And we know markets like to overshoot. So heading into Friday's session, we knew it was possible that we could start red and possibly finish green. And that is exactly what happened. Down 88 points or something like that intraday, we finished up 8. It's a daily chart of the S&P 500, a time frame that's much more relevant to what we're trying to accomplish as investors. We've covered this chart numerous times in recent months. And as you can see, as of the close, and even during the session on Friday, November 7th, we really hadn't violated anything that was particularly concerning. In fact, intraday, we came down near the upward sloping 50-day moving average and reversed and held. This chart shows closing prices only. If you switch over to high-low close bars, you can see that we did undercut it intraday, and then we closed above it. This is the chart in front of us. It tells us that thus far, we have ample evidence on multiple time frames and using literally hundreds of inputs that tell us, for now, we can prudently remain patient. It doesn't predict anything. It gives us reference points. And if you're a client that recently made a deposit to your account, since you already have ample capital in harm's way, we would prefer to see this 39-minute chart get out here before getting too aggressive with new cash. Haven't even cleared these two levels here yet, and haven't broken this short-term downtrend. So this is a good setup, what happened on Friday, but the market still has some work to do in the short run. Too early to say whether this bearish episode is over yet, but big picture, things still look good. You can say the same thing for the technology sector. You can see it was extended from the upward sloping 50-day moving average. We still clearly have an uptrend, even based on the low that was made earlier in 2025. And XLK could fall a long way without doing significant damage to that trend. So we have numerous reference points below, and we'll continue to take it day by day. Chart on your screen as it'll close on Friday, November 7th. Consumer sentiment print that came out on Friday. Extremely low, almost at an all-time low. Here are the questions over here, and here are the answers down here. If the S&P 500 fell 5% from its recent closing high, it wouldn't do really any damage to the current uptrend. The S&P 500 was extended. Not surprising that we're pulling back here. In fact, the next 1 to 2 weeks, almost a coin toss for the week. 61% of the cases were higher 2 weeks later. But a year later, 94% of the cases higher when you had an extended market. The average gain, additional gain, 13.6%. And this condition here is indicative of a strong trend. Thus, it's not particularly surprising if we look at these signal dates. Here's the source of the study. This is a Twitter handle. The maximum 1-year drawdown after similar signals, fairly muted. Median was 2.32%. It's basically in the neighborhood that we're in now. Average maximum 1-year drawdown after these dates here, 4.33%. Thus, if the S&P 500 backtracked to really anywhere between 6,500-ish and 6,700-ish, 100% normal and to be expected. Thus far, we've been right around this range here. As history has demonstrated in this week's video, markets can go up for a long, long time. In the context of the scary topic related to the present-day stock market being in a bubble that's about to pop. Telling us the bubble topic is not particularly helpful relative to trying to make prudent investment decisions. And we all know, commentary in this week's video is based on the charts in front of us. If the data and charts start to shift in a material manner, we'll have to reassess the probabilities. We also know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.